banks are walking away from the UK housing market. Not quietly, not gradually, and not by accident. They are doing it because the numbers no longer work, because the losses are no longer hypothetical, because the risk is no longer manageable, and because the institutions designed to prevent collapse are now openly warning that they may not be able to stop what's coming. This is not caution. This is alarm. And when banks hear alarm from the institution that sees every balance sheet, every loan book, and every default in real time, they do exactly one thing. They pull back. They stop lending, they tighten credit, they walk away. Banks don't leave markets because of headlines. They leave because of math, and the math has turned hostile. The UK financial system is facing multiple simultaneous shocks, and those shocks are no longer spread out over years. The timeline has compressed to months. That single phrase explains everything. It means the losses banks expected to absorb gradually are now arriving all at once, and housing is at the centre of that collision. Before residential housing breaks, commercial property always goes first, and it already has. Commercial property loan defaults have tripled in just 6 months, rising from 1.5% to 4.5% across major UK banks. That's not stress, that's failure. These defaults now represent over £60 billion in loans already in trouble, loans banks expected to be safe. Worse still, banks assumed they would recover 60 to 70% of those loan values. In reality, they are recovering 40 to 50%. That missing 20 percentage points is not a rounding error, it's a capital hole. And there's more coming. Another £80 billion in commercial property loans are already showing early-stage warning signs: missed payments, valuation write-downs, and restructuring requests. Defaults are accelerating. They rose to 5.2% in December, up from 3.8% in October. That is exponential deterioration. Banks are watching this curve and drawing the same conclusion. If we keep lending aggressively into housing, we amplify losses we already can't absorb, so they pull back. Banks don't separate money into neat little boxes. Losses in commercial property directly weaken their ability to lend to households. Every pound lost in commercial property reduces the capital available for mortgages. This is how housing gets hit even before prices fall. If commercial property cracked the balance sheets, households are now crushing them. Mortgage payments more than 90 days overdue have surged 78% year over year. Early stage arrears, the leading indicator, are up 112%. These do not resolve, they escalate. Credit card balances are at a record £95 billion, but the danger is hidden. A growing share of borrowers can only make minimum payments. That means no repayment, no margin, no resilience. Credit card delinquency rates have jumped 50% in a single year. County court judgments are up 67%. Personal insolvencies are up 45%. This is not consumer stress, this is consumer failure. Banks don't wait for defaults, they price risk ahead of time, and projections show that if current trends continue for just 6 more months, mortgage arrears will hit 3 to 4%, the same levels seen during the 2008 financial crisis. At those levels, banks face losses large enough to threaten capital adequacy. Combine that with commercial property losses, combine that with corporate failures, and lending stops being profitable. It becomes suicidal. Housing does not collapse in isolation. It collapses when jobs disappear, and jobs disappear when companies fail. Corporate insolvencies jumped 38% in a single quarter, with over 5,000 companies failing in just 3 months. This is not isolated to retail. Construction, professional services, and manufacturing are all failing at accelerating rates. Profit warnings are at their highest level since 2009. Credit downgrades are accelerating. Companies are drawing down credit lines aggressively, a classic pre-default behavior. Trade credit insurance premiums are rising because insurers expect non-payment. This creates a loop. Corporate failure leads to job losses lead to mortgage defaults lead to bank losses lead to credit withdrawal, and credit withdrawal causes more corporate failure. Banks see this loop forming, so they exit early. And then comes the final trigger, the remortgage cliff. The central bank knows exactly when every fixed-rate mortgage expires, and the wall is directly ahead. Between January and June 2025, 2.4 million mortgages roll off fixed rates. The average rate on those mortgages is 1.8%. The rate they must refinance at is 5.7%. That is a 93% increase in monthly payments, nearly double. Affordability models show that between 22 and 28% of those households will face a genuine affordability crisis. That's between 500,000 and 670,000 households. Of those, 30 to 40% are expected to default or be forced to sell. That's up to 270,000 forced sales entering the market. This wave is guaranteed, the passengers are known, the timetable is fixed, and the crash zone is visible. 6 months ago, the risks existed, but they weren't accelerating. Now they are. The rate of deterioration itself is increasing. That is the most dangerous signal in finance. This is why the warnings changed. This is why the language hardened. And this is why banks stopped believing they could outrun this cycle. The central bank does not publish fantasies. It publishes contingency plans. And there are 3 scenarios banks are preparing for. The optimistic scenario still includes a 15 to 20% house price fall, unemployment rising to 6 to 7%, and a recession. That is the good outcome. The second scenario is severe stress. House prices fall 25 to 30%. Unemployment hits 8 to 9%. GDP contracts sharply. Multiple banks require support. Forced mergers occur. Recovery takes years. This is the scenario banks are actually planning for. The third scenario is systemic collapse. House prices fall 35 to 45%. Unemployment exceeds 10%. Major banks fail. Emergency measures are required. Recovery takes a decade or more. This scenario is not emphasized publicly because describing it risks triggering it, but the fact that it exists tells you everything. A 30% house price fall is not extreme, it is mechanical. Household leverage is higher than in past crashes, mortgage terms are longer, affordability buffers are thinner, and rates rose faster than at any point in modern history. Banks see the math, they stop pretending otherwise. Policymakers cannot save housing this time. Interest rates cannot be cut aggressively. Government finances are strained. Balance sheets are bloated. Credibility is fragile. The tools that worked in 2008 are mostly exhausted. One phrase appears repeatedly in the latest report that never appeared before: systemic disruption. That phrase does not mean volatility. It means payment failures, credit freezes, institutional collapse, and normal operations breaking down. Banks do not lend into systemic disruption. They retreat. The central bank knows which institutions are most vulnerable. It knows exact exposures and exact capital buffers. It cannot name them publicly, but it is having private conversations, raise capital, prepare for mergers, reduce exposure, now.
Banks respond quietly, mortgage approvals fall, valuations come in lower, high loan-to-value products disappear, buy-to-let criteria tighten, developers lose financing, no headlines, just absence, and absence of credit is what kills housing markets. Forced sellers do not negotiate, they accept the bid. That resets comparables, that resets valuations, that breaches covenants, that forces more sales. This is how declines accelerate. Banks see the pipeline and refuse to add fuel.
This is the feedback loop. Banks pull back, credit shrinks, transactions collapse, prices fall, equity evaporates, defaults rise, losses increase, lending tightens further. This is not speculation. This is how housing crashes unfold when credit contracts. Prices can fall slowly, liquidity disappears instantly, and the warning is explicit. The system may not be able to absorb these shocks without significant disruption. That is an admission. If this accelerates, control may be lost. Banks do not wait for confirmation, they exit early. This is not about fear, it is about timing. The timeline has compressed from years to months. That is the warning, that is the signal, and that is why the UK housing market is entering its most dangerous phase.